Coming up on Market to Market. A key report reveals increasing supplies of corn and dwindling stockpiles of soybeans. America's farmers are predicted to plant a record amount of soybeans, but fewer acres of corn. And traders ponder the impact of the latest reports during a volatile week in the commodity markets. We'll examine scenarios for bulls and bears with a blue ribbon panel of market analysts next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.
And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, April 4 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. With spring planting just around the corner, we're going to depart from our traditional format this week and devote our entire program to an examination of the markets. We've invited 4 of the best analysts in the business to offer their insight on where these markets just may be headed, and we'll get to them in a moment. But here's the backdrop. The Agriculture Department released its prospective plantings and quarterly stocks reports this week, fueling volatility in some already choppy markets. For the week, May wheat lost 26 cents, while the nearby corn contract moved nearly 10 cents higher. Soybeans extended last week's rally as the May contract rose 37 cents. Nearby meal followed suit with an upward move of $10.70 per ton. In the softs, cotton's recent rally ran out of steam as the May contract lost $1.34 per hundredweight. In the dairy market, April Class 3 milk gained 11 cents, while the deferred contract moved 36 cents higher per hundred. Over in livestock, the June cattle contract lost $3.55. Nearby feeders were off nearly $1, but the big story was in the pork sector, where the June lean hog contract lost a whopping $9. In the financials, the euro gave up 6 basis points against the dollar. Crude oil declined by 43 cents per barrel. COMEX gold advanced by nearly $10 per ounce, and the Goldman Sachs Commodity Index lost more than 5 points to settle at 645.15. Here now to lend us their insight on these and other trends are 4 of our regular market analysts. Sue Martin is the president of Ag and Investment Services. She was one of the first women in her field and has appeared on this program for many years. Virgil Robinson is DuPont Pioneer's Market Analyses Manager. With more than 35 years of experience as a grain merchandiser, broker, and consultant, he's also been a fixture on this program for decades. Naomi Bloom is a market advisor for Stuart Peterson. A relative newcomer to Market, Naomi co-founded Women to Women, a program that educates women about farm marketing. And Walt Hackney, another Market regular who's appeared on this show forever. Walt founded Hackney Cattle Company, which provides risk management and marketing services to livestock producers. Folks, welcome to this special edition of Market to Market. Sue, let's begin with you. In the report on Monday, on the old crop corn side, we got a little food for the bulls. Talk to us a little bit about what we saw in the numbers that gave us that pop on Monday morning.
Well, I think one of the biggest things in the report was everybody's focus had been on what the feed and residual number would be. There was a thought process out there that number was overstated. And so basically, they found in this report that, according to the USDA, it was not overstated. In fact, that number increased. And I think that, for me, I believe it's a believable number. I think that we had a very late fall or a very late harvest last year, and therefore a lot of the corn crop, was not commingled with old crop. And I think that, going into winter came early, it was cold. We've been feeding animals much heavier, be it whether it's hogs in the case of PED virus and trying to make up for lost animals, or in cattle feeding them heavier because of the cheap corn. And let's face it, the year before we were feeding a lot of alternatives because we didn't have the corn. Now we have the corn, dirt cheap, And so they love to feed corn if they can. And I think that was occurring. And then our poultry industry did not expand through the winter. It cost too much to heat those barns. But that's an expansion that's happening. And I think that's very friendly, of course, for corn and for soybean meal, both. The acres, I think, were pretty much in line with what the Ag Outlook was kind of talking. Came in underneath what the average trade guess was talking, but we have a lot of time between now and the time corn gets finished planting, and we have to remember that last year I think 40% of the U.S. corn crop went in 1 week. Doesn't take long to plant it if you can get in, but after having people remember what happened the most recent, and of course that's last year's Prevent Plant. 8.3 million acres that really have not been, I don't think, accounted for very well by the USDA.
But accounted for by the USDA in?
As to how many acres to, like, say, corn was Prevent Plant, this sort of thing, and where they were. The other thing I think is that because of that, I think psychologically, as we move towards, if we get into May, and we have a 5 in front of our calendar date, and not much corn's gotten planted, this market's going to be moving more aggressively than it has. We have huge saucer bottoms on the charts, very friendly. Myself, I have indicators that I watch. They are very, very low in percentage, and they're timing indicators, and I have a hard time being bearish corn. I like corn a lot.
All right.
And it hasn't even, as far as I'm concerned, gotten close to where it's headed.
All right. Now, Virgil, one of the things that I know you've studied a lot as a market analyses manager, one of the numbers in the USDA grain stocks report was that of the corn stocks that we have on hand, a little over 7 billion bushels, about half of that, or a little over half of that, is considered stored on farms. Correct. How accurate can we anticipate that number to be? Where do they get it from? Is that all survey generated?
Survey generated, Mike, and please understand there's margin for statistical error and measurement error, so clearly that can change over the course of time. But to the point of stocks on farms, you are correct, and I think producers have done, to this point, a fine job of metering their stocks on hand to the marketplace and rewarded both an increase in flat price as well as an increase in basis. I think there's an awfully good article that just hit the media today out of the University of Illinois addressing the very subject you two have been discussing. So with respect to are there more acres than what were reported in this survey, I would refer people, I think, to that piece. It does address statistical and measurement error and incorporate last year's numbers and this year's numbers, and there's a good explanation there.
All right. Now, as we talk this old crop corn, for producers who still have that 3.86 billion bushels stored on farm, as we look at this rally that we saw this week, Naomi, would this be a great time to get in there and make some sales, or is there still some upside in the old crop?
If you're at a point where you need the financial flow for whatever reason, this is a great time to reward the rally. Yet, I think with the USDA report that came out in terms of the stocks and in terms of the planted acres, there really is some potential upside. It's nothing that is going to go rip-roaring, racing higher, but it's something that can gradually climb higher. And I think regarding even the new crop, this week on December weekly corn charts, it posted a bullish reversal, which is a really big indicator. And if we closed over $5 today, there's some technical upside potential here, and with the right weather market, we could really see another push higher. And looking at the chart, the way I see it, 575 is the next target higher if we get the weather issue to substantiate it. But 575 futures for December futures is where I think we can go.
All right. And Sue, you mentioned you saw some upside potential. Does that 575 seem reasonable to you?
Absolutely. I agree with Naomi. We've got increments of 521 on Dees, 550, and then 575. 573.74 was the high for Dees corn a year ago in June. And that's going to be kind of and if you look at a chart long term, anyway, that if you draw a line going back in time, that's kind of tabletop flat resistance. Once we exceed that and take it out, there are huge continuous contract gaps above this market, and we haven't even gotten close to those. Beans have almost filled theirs on the May, but I like corn a lot. The chart formations are good. I see great fundamentals coming. We've got to remember you have less acres in the U.S. than a year ago for what we started off with, and you've got South American acres down, even though their production's ratcheted up a little bit from what they were talking. I just think that corn has great potential, and especially if we start to talk about some fundamentals in wheat.
All right. Now, and you mentioned soybeans. Let's take a look at that. Virgil, in the report, we saw soybean stocks on hand, old crop at about 992 million bushels. Does the market feel that that's the realistic number? I mean, is that kind of that's what we're trading going forward?
Well, you can kind of track disappearance with regards to export sales, Mike, on a weekly basis. The one that's more difficult, of course, is domestic usage because of its elasticity and the lack of reporting services that were discontinued for the most part because of budgetary concerns. Interesting that this week, the National Soybean Cash Index has in fact gone above where we were a year ago. So clearly the market has acknowledged this old crop, new crop dichotomy. And I think over the course of time, it'll be interesting to me to see if we get on a timely basis the number of soybean acres planted in Arkansas, Louisiana, Mississippi, and those areas that could take advantage of this current price inverse. Now, seed sales, and I'm not at liberty to speak to those, but I can tell you we've done good business in that region of the country selling soybeans. So there's going to be an effort made by producers to try and produce beans in a timely manner to take advantage of this inverse. So be advised of that. Processing margins have deteriorated. Spot margins are worse today than they were a year ago. We've not yet seen the cancellations that were assumed we'd see, particularly out of the Chinese, but certainly that could yet happen, Mike. So I like the market. The underpinnings to the old crop soybean market remain strong. It would be very arguable that we yet have to ration soybean usage in an effort to make the transition from tight old crop stocks to what we assume will be record new crop stocks. But don't lose sight of the fact there's a big crop of beans in the southern hemisphere as well.
You bet. Now, Naomi, as we talk old crop, on Monday, the report day, we saw folks had been selling off into the report. 11 o'clock hit, we got a nice pop. Is that a trend like corn that's going to continue, do you predict?
With the soybeans, it may follow the corn higher, but with the fundamentals right now of the new crop beans, it's definitely the follower in the whole situation. We have the possibility with the large acres and just a nice average yield to have carryout potentially go to 225 million, which is probably the most we've had in 6-7 years, and that's a very comfortable number. So it's something where if you look at a chart of November beans, there's real strong support at $11 in the bigger picture. And right now we're very comfortable at $12, and the market is just trying to decide, do we have enough reason to try to take another baby step higher, or do we need to set back a little bit? And for now, I would say over the next month, the likeliest scenario for those November beans is to see them stay range bound between $11.75, maybe go up to $12.25 and continue into like a pennant flag formation, and just kind of take its cue from corn and also the weather.
And in that vein, should producers sitting there today, aware of their planting intentions, be making some sales at $12 with the knowledge that we could take a step back, or do you wait and you hope for a weather event?
With the beans, I think I would be a little bit more aggressive to be making some sales, because corn fundamentally and technically has the bigger potential on the upside. But at the same time, if you wanted to hold off on some, please have a line in the sand where you know that you're going to pull the trigger and make the sale in case things at all fall apart lower. So do nothing might be okay for a few weeks, but at the same time, if the weather turns out to be fine and planting starts humming along, like you said, with all of the acres in the south that are going to potentially come to market sooner than later in the late summer, the beans might slide lower sooner than later.
All right. Now let's talk wheat a little bit. Well, we saw the wheat market fall apart this week. A little bit. We were down about 30 cents. You travel all the time. I know you were down in the Southwest this week. What did wheat country look like?
Depending if you're dry land or, of course, irrigated, geographically depending if you're in northwest Kansas or in the Oklahoma, West Texas community. In that case, the West Texas, Oklahoma community is extremely dry. And they've had insurance adjusters on the wheat as we speak, and they're forecasting 1 to 2 bushel per acre production off of that wheat, which qualifies it obviously for insurance. You get northwest in that St. Francis country and up in northwest Kansas, I'm not sure, but what they may have picked up more winter and more snowfall and more high moisture in that area to help them promote some extra wheat growth up there. I do know that they had to take cattle off of wheat prematurely in all of that area back in probably mid-February to early February, and those cattle were part of this extremely high placement factor that was in the last cattle on feed report. And they were very light, and they are strung out as far as marketing goes. There isn't any continuity to the weight proportionate to finish date on those cattle. They run from 350 to 650 pounds going into the feedlot because there isn't anywhere else to go. And so in that regard, I would suggest that the cattle feeder in that country, if corn does what these experts are indicating, I would be deeply concerned, because in my procurement of grain stuff, because usually you can in fact feed up to 40% of your grain ration in an 80% ration of corn. You can take 40% of that ration as wheat, and you can run it. Now, if wheat is in fact in a shortfall position for production, and corn is going to do what these folks are indicating, I would feel very, very vulnerable to what to buy in regard to my needs.
Well, and you've opened the door here as we discuss cattle coming off the wheat pasture, talking the feeder cattle market. Where are we at today with feeder cattle pricing, and how much more upside is there?
I believe that the run-up is fairly well over in regard to feeder cattle. I think the emotion behind that market has fairly well run its course. I suggest, in our own observation out here, and in what we're bidding on cattle compared to a short week 10 days ago, I would suggest that these yearling cattle are going to be $4 to $6 a hundred cheaper. I think that calves, I don't know, but in a calf bringing $225, that calf could drop $25 in a moment. And so if this indication here on this corn thing becomes reality, those people are going to take a much more serious view of their procurement efforts. Some of them are going to go empty on their pens. They're not going to run the risk of the corn jumping and feeder cattle not able to get them bought cheaper.
All right, well, when you said the emotion behind this market, we got some nods from around the table. We had a lot of murmuring. Sue, I mean, is that, in your opinion, also what's been fueling this market? Has it just been emotional, get them bought while you can?
Well, I think it's been the fear of tighter supply coming, and the very tightest, the tightest calf crop that we've had in 50 years or whatever. And I think that's part of it. But I agreed with Walt when he said he thought that we'd put a top in here this week or whatever on feeders, because I do wave counts, and wave 4 is, and not very many markets seem to be hitting wave 4s this year, but wave 4 on May feeder cattle is 181.52, I believe, and we've gotten to 180.60. We're within that window. So I think we have to be very cautious. Let's put it this way. I don't think feeders are going much higher either. And I think weather plays a hand in this too this year. It depends on when the El Nino hits. If it comes in earlier, some climatologists are saying it will. If it hits into June, then, by July, you've got some nice rain coming in. The west will catch rain. The southwest will get some rains. But if it doesn't, and it waits till August to September, like other climatologists are saying, and that may be very reliable that it does that, then what I believe is a whole host of things that happen. One is then maybe you've had a break. Your August and October feeder cattle make a low, maybe in late July. Sometime in July, they come in a little bit earlier on their seasonal low, and they start to come back up after they've had this good correction. And a seasonal time frame for down in the markets is June anyway. But in the meantime, then you look at the grain, and we start to, granted a wet fall is what we would have. That would be friendly to new crop grain because you're not getting it out of the field very easily. But what are you doing? You're replenishing the soils to turn around and come back and have a bearish year in 2015.
All right. Well, while we're talking cattle, Walt, as we look at the fat cattle pricing, we're still dealing with a situation where cash cattle prices are anywhere from $5 to $8 over the board. Do you see this basis continuing as we head into first notice day was today?
I think this week is pivotal. I agree with Sue in regard to what has gone on most recently. If you used any kind of a calibration for the last month, 6 weeks, 2 months, there was no end to the availability of monies to buy feeder cattle, and there was an enormous lack of availability of feeder cattle to spend it on. Now, all of a sudden, this week, reality has set in, I believe, and I believe that the cattle feeder not only is looking at the potential of feeder cattle having had too high of an explosion up there, I think that what has been said here should press an alarm button for a cattle feeder and a hog producer. If the soybean meal goes into orbit if the corn goes beyond this 4.5 to 6 bits a bushel, a cattle feeder has got to take a deep seat and a faraway look in regard to what is it he's going to do, because he cannot buy an $85, 750-pound yearling steer, feed him $5.56 bits corn, and make it work. There is no way that even a prayer book will not help them in that regard.
All right. Well, Naomi, while we're talking cattle, let's talk another cattle byproduct, dairy market. Yeah. High after high after high. We've been 23 for a while. Is this going to continue as well?
No.
Okay.
We're at the point where the price is high, and part of the milk price, of course, is made up of components of butter, cheese, whey, powder, those types of things. And we've actually seen the cheddar price here recently set back. And so the leading indicator is the Frontier market, which is part of the New Zealand market. And our cheese price here is actually trading 30 cents above this other New Zealand price. And so when that New Zealand price starts to work its way a little lower, our market follows. And we're going to start to probably see that happen within the next week or two. And so do we think that the price of milk is just going to just tank and fall apart? Absolutely not. But the swing higher that we've had is probably going to start to go sideways to where we see front month milk trade at $20 and maybe the summer months set back towards $18. So still really strong prices overall, but when they had $23 earlier this week and then you had one contract of milk limit down today, the volatility is coming. And even though our export markets are strong and the demand is there, we are feeding these animals and we have record production of milk. Mm-hmm. And if the demand starts to ease up a little bit, we're going to see the milk prices ease up too.
All right. Now, one of the other big stories this week was the $9 slide in the front month hog contract. Walt, what happened?
Well, it'd be really simple to say I have no opinion. but actually, I guess my curiosity is extremely high because of the abrupt way that it occurred. Is there some indicator out there that says they have found a cure for PED? because that's what's driven the hog market at this point for several weeks. And it has progressively driven it higher and higher to the point where it seemed a week ago, 10 days ago, there was no end to the optimism in the hog pricing. And these hog producers are sitting out there today feeding hogs cheaper with the 450 corn and so forth. They're feeding hogs cheaper today than they have for a long, long time. And you know what? They're making a hog today, average market weight, 9 pounds heavier than a year ago. That's fatal in the hog industry when you consider 415 to 425,000 head of hogs being marketed a day, 2 million plus a week. And you add that extraordinary tonnage to that. With our exports, is there any sense to the rumor that China has asked us not to ship any more pork to them for a while? Well, what's going to happen with that pork when it's 9 pounds heavier than a year ago? Take 9 pounds times 415,000 hogs a day. That is a bunch of pork chops.
It's a lot of weight coming on the market.
It really is.
Thank you, Walt. Thank you, Naomi. Thank you, Virgil. And thank you, Sue, for taking the time to be with us tonight. That wraps up this special edition of Market to Market. But we'll continue our discussion with our Blue Ribbon panel of experts and answer some of your questions in our Market Plus segment online. You'll also find audio podcasts and streaming video of our program, as well as links to our Twitter feed, Facebook page, and the rest of our social media outlets exclusively at the Market to Market website. And be sure to join us next week when we'll visit the world's largest futures exchange to examine the increasing role of technology in commodity trading. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.
And by Sukup Manufacturing Company. Offering a full line of grain drying and storage equipment and steel buildings, Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.